We are looking at a number that shouldn't exist. It is a liability so astronomically large that it defies the laws of physics, mathematics, and finance combined. For the last 48 hours, the symptoms of a systemic infection have been flaring up across the global market's closed mints, vanishing premiums in Shanghai, and unexplained flash crashes. But these were just smoke signals. The fire itself is burning deep within the unverified, off-balance sheet ledgers of the world's most powerful financial institutions. A document circulating through institutional trading desks suggests that we have crossed a terminal event horizon. It points to a shadow short position held by two U.S. banking giants that totals 4.4 billion ounces of silver. To be clear, if this ledger is accurate, the financial models we use to understand the world are no longer valid. We are not discussing a bad trade. We are discussing a mathematical prison. To understand why a 4.4 billion ounce short position is a death sentence, you must first understand the hard reality of the physical world. Entire planet, every mine in Mexico, Peru, China, and Russia combined can only claw about 800 million ounces of silver out of the earth each year. That is the hard ceiling. We cannot print more metal. We cannot conjure it from thin air. Now, do the math. If these banks have sold 4.4 billion ounces into the market, they have effectively sold 5.5 years of total global supply. They have sold silver that has not been mined yet. They have sold metal that will not see the light of day until the next decade. This is the textbook definition of a naked short. They have sold a promise they physically cannot keep. In a functioning market, a short seller borrows an asset to sell it, hoping to buy it back cheaper. But for that mechanism to work, the asset must exist. Where are these institutions going to find 4 billion ounces? The vaults in London are draining. The registered inventory at the COMEX is a fraction of what is required. Whether the real number is 500 million or 4 billion, the trap is the same. They are caught in a volatility vortex of their own making. This explains the violence of the recent price action. When you see the price of silver crash $6 in minutes, the media calls it profit-taking. That is a lie. That is a desperation move. It is a survival algorithm trying to prevent a margin call that would liquidate the bank. Consider the stakes. Every time the price of silver rises by a single dollar, a 4.4 billion ounce short position loses $4.4 billion. When silver moves from $50 to $90, the paper losses exceed $160 billion. This is why they smashed the price. They are not trying to make money. They are trying to stop the bleeding. They are trying to prevent the clearinghouses from seizing their assets. But this creates a black hole. By selling 5 times the annual supply, they have created a future demand shock that is 5 times larger than the supply can ever satisfy. Bank of America and Citi are not sellers of silver. They are guaranteed future buyers. They just haven't paid the bill yet. This realization flips the narrative completely. We are not looking at an overbought market. We are looking at the most oversold asset in the history of finance. Compare this to the Volkswagen squeeze or the GameStop saga. Those were sparks. This is a nuclear reactor melting down. The potential energy stored in this trade is infinite because the liability is unpayable. If you hold a paper contract, your counterparty is likely an entity that is technically insolvent. They hold billions of ounces. They hold millions of ounces. And the gap between those two numbers is where the entire financial system begins to fracture. We need to calculate the insolvency number. This is the math the mainstream analysts are too terrified to broadcast. Take a price of $90 per ounce and multiply it by the rumored 4.4 billion ounce short. The result is roughly $396 billion. Let that sink in. That is not a quarterly loss. That is a solvency event. The combined market capitalization, the total value of all shares of these banks, is roughly equivalent to that liability. If they were forced to cover today, their equity would be zeroed out. They would cease to exist as solvent entities, and that assumes they can buy the silver at $90. If they actually tried to buy that volume, the price would not stay at $90. It would go vertical. This equation drives the market behavior we are witnessing. The banks are trapped in a loop. When the price rises, they face immediate liquidation. So they sell everything: paper contracts, gold, equities, to smash the price back down. They burn billions in capital just to survive one more day. But the relief is temporary. The price rips back up because the physical market is screaming for metal. We are seeing backwardation, a rare phenomenon where the spot price is higher than the futures price. This means the market is saying, I don't want your promise of silver in 6 months. I want the metal now, and I will pay a premium for it. Lease rates are skyrocketing because nobody is willing to lend their silver to the banks anymore. The vaults are closing their doors. This is not just a banking crisis, it is a systemic crisis. These institutions are the plumbing of the global economy. If they fail, the credit markets freeze. This is why the Federal Reserve and the Treasury are involved. They are trying to engineer a soft landing for a bomb that is already detonated. But you cannot print silver. The only way out is to print dollars, trillions of them, to bail out the shorts. This means the price of silver is rising not just on supply and demand, but because the currency itself is being diluted to save the arsonists who set the fire. But why now? Why is the system breaking in 2026? To answer that, we have to look beyond the balance sheets to a hand-drawn chart from 1875. Samuel Benner, a prosperous farmer, noticed a rhythm to the madness of markets. He mapped out a cycle of panic and boom that has held true for 150 years. The Benner cycle circled the year 2026 as a time of high prices and a time to sell stocks. In Benner's language, this marks the blow-off top, the peak of the paper mania before the rotation into hard assets. The banks bet against the cycle. They assumed the paper age would last forever. They shorted the commodities supercycle right at the moment history dictated a massive rotation into raw materials. They are standing on the beach trying to hold back a tidal wave with a sheet of paper. The Benner cycle dictates that capital flows from overvalued stocks and bonds into undervalued commodities. We are witnessing the friction of that rotation. The banks are on the wrong side of history, fighting physics, math, and time itself. So, how does the endgame play out? If the banks cannot buy the metal and cannot borrow it, they have one final card to play: Force Majeure. It is a legal escape hatch hidden in the fine print of every futures contract. It allows the exchange to declare that delivery is impossible due to circumstances beyond control. Instead of giving you the silver you paid for, they will force a cash settlement. They will send you a check for the paper value of the contract and close your position. This is the ultimate rug pull. You don't want dollars, you want the asset. By the time they mail you the check, the real street price of physical silver will have decoupled completely from the paper price. The screen might say $90, but try buying a physical bar for that. The dealers will quote $150, or they will simply have no stock. This is the separation of the paper market from the physical reality. The COMEX becomes a museum of zombie prices, while the real market moves to Shanghai and private vaults. We are watching the death of the derivative market in real time. The volatility, the smashes, the panic. It is all noise designed to shake you out of your position. They need your physical metal to cover their naked shorts. If you sell now, you are bailing them out. The wealth transfer of the century is underway, moving from those who hold paper promises to those who hold real things. The insolvency equation has been solved. The Benner cycle has turned. The only question remaining is whether you will be holding the asset or the settlement check when the music stops.